Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is actually a returning guest. I'm not sure if he remembers, but I interviewed him. Me and my former business partner interviewed him a number of times many years ago. So I've been following his work when he was writing these really extensive Seeking Alpha articles on mispricings for small cap and mid cap oil companies years ago. Big fan of his work. His fund, actually, his energy fund, was the top performing energy fund in the entire world, according to the data metrics. He started off writing a lot of really in-depth articles on Seeking Alpha many years ago. Josh Young is the Chief Investment Officer and founder of Bison Interests. Bison Interests is an investment firm focused on publicly traded oil and natural gas companies. He has over 15 years experience in investment management, 10 of which are focused specifically on oil and natural gas companies. He became chairman of the board of RMP Energy in 2017. After refreshing the board of directors and the management team, he rebranded the company as Iron Bridge Resources, and it was bought out at a 78% premium in 2018. It's pretty impressive, considering that was pretty much a shale oil bubble and a bear market for a lot of natural gas stocks. Josh was a management consultant to Fortune 500 companies and private equity firms, and then an investment analyst at a private equity fund. And he's also worked as an energy investment analyst for multi-billion-dollar single-family offices and nominated as the Institutional Investors Single-Family Office of the Year in 2008. So, Josh Young, thank you for coming back.
Great. Yeah, thanks for having me.
So, Josh, I want to get your top-down view of the oil market. We're recording this interview right now on Friday, May 13th, Friday the 13th. The oil price, the WTI crude oil price for reference here is at $110. Natural gas is a little under 8 at 7.66 here in the US. I want to get your view because you've put out a lot of really great research. I've cited this often since the research pieces came out in October and November of last year. Your firm has been publishing research papers on supply side problems for OPEC and OPEC plus oil producers for a while now. Do you think that going forward, the Saudis, as well as other OPEC and OPEC plus producers, will struggle to maintain oil production, let alone be able to grow oil production in the future?
Yeah, Jason, that's a great question. And it's kind of weird because I was just looking at one of these charts and they've missed their quotas every month for more than a year now. And it's still weirdly contentious to say that they can't make their quota and that they don't have spare capacity. And so, the Saudis are pretty close to empty. UAE has a tiny bit left. But the real test was a month and a half ago when Russia invaded Ukraine and prices spiked to, I think, 130 or so. I think Brent might have got close to $140 a barrel, and we didn't see OPEC respond. And I think that was kind of the true indicator. Missing your quotas is one thing. There are various reasons to do it. But when you see prices spike like they did on a giant geopolitical event, and then you don't see an OPEC response, I think they're telling you that they're out.
I 100% agree. And for many years in the past, Josh, in my day job in the past, I was an oil and energy analyst. I worked with Robert Rapier at Investing Daily for a while. It used to be common knowledge in the oil market. I would speak to oil traders and also hear from other industry experts that the OPEC countries routinely cheated on their quotas by producing too much oil. And that was for many years in the past. But those days seem to be long gone. And I think a lot of this is because of how inefficiently run these national oil companies are. They are not prudently run like a private sector oil company that has to be capital efficient if capital is scarce, that has to focus on profit margins and free cash flow. These are national oil companies, basically government-sponsored enterprises. And these businesses, well, if you can call them businesses, these national oil companies, their free cash flow, if they have it, because oil was not profitable for many years over the last decade, the oil industry, they're not allowed to reinvest their free cash flow and their profits back into the business like a private sector oil and natural gas company would.
That's those are some aggressive claims. I don't know if I'd go that far. I think that some of these national oil companies are quite good at the things they do. I think the thing that they are generally best at in aggregate is, like you said, distributing out cash. And so And actually, ironically, that's the direction that a lot of oil companies are going right now worldwide. So maybe there are some lessons that Aramco can teach Exxon and Chevron and some of the other US and international oil companies. But, you know, I think it's less about efficiency or capability and more about the capability of the reservoirs that are being tapped, as well as the reinvestment, like you were saying. And so I think it's just been, there's been insufficient investment, and then the biggest and most productive fields have seen their best days and maybe in significant decline. And so it's the combination of those things. Some of the people at these companies and some of the people running these companies are quite talented. And I don't think it's about them as much as about the business models, and then about the rock and the oil pools essentially starting to run out.
Well, I think there's good petroleum geologists at these companies, but I think their hands are tied by government and bureaucracy, because Mexico and Pemex, I wrote a piece on this a few months ago for my patrons talking about this, where more and more of their revenues, their oil revenues, were taken out and used to fund the Mexican government and social programs. So this has been common throughout Venezuela. It's happened in other oil exporting countries where the domestic consumption of oil grows enormously, normally because the gasoline price is very heavily subsidized. And then the oil business itself, while they had those cheaper fields, like you said, those cheaper low-cost fields like a Gawar in Saudi Arabia or Cantarell in Mexico, they didn't reinvest into those businesses because a lot of the oil profits were spent to fund the government, to fund social programs, and they didn't have as much extra free cash flow to grow and reinvest in their business with the Capex. So I think the problem is not the oil business itself. I think the problem is that government that controls these oil assets in those countries has decided that they need the oil profits to fund government and social programs.
Yeah, I mean, sure. Like Pemex has its own whole set of issues. Each of these companies in each of these countries has their own sort of issues. But I guess what I was speaking to, I mean, frankly, Mexico, and maybe this is because of mismanagement there, Mexico isn't that big a deal in the global oil market. But Saudi and Russia and a number of the Gulf states, those are a big deal. And, there it's a lot more complicated.
So do you have estimates then on how much of a CapEx shortfall would be needed? Because I think the average person who's listening to this doesn't understand that it takes years and many, many billions of dollars of investment in order to grow oil production by 1 million barrels per day or more. So what is the CapEx shortfall, would you say, that OPEC Plus, the private sector needs to invest to start growing oil production a couple million barrels per day again?
So, this is a great question, and it's complicated because it depends on what the service cost environment is like. And so it's dynamic. So you can't say $100 billion or $1 trillion, because if you're spending $1 trillion, you might only get $500 billion worth of stuff because there's so much oil field cost inflation. And then if you spent $100 billion in a year, you might get 200 or 300 billion worth of stuff because there'd be significant cost deflation because of significantly reduced activity. But with all of that sort of sensitized, I think Hess's CEO came out this week and said that he thinks there needs to be at least 500 billion a year in investment. And the consensus a few months ago was that there was going to be 250 billion of investment this year. And then globally, and then just for context, in 2014, there was 490 billion of global investment. And then there's one other aspect of this, which is that people focus on the upstream spend. That's where all those numbers were. But there's also a whole value chain that's been materially underinvested in. And so one of the things we snuck into one of our macro pieces, I think a month or two ago, I think it was just in a webinar, I don't think we included in a white paper, the top 3 oil services companies just traded in the US. So Halliburton, Baker Hughes, and Schlumberger, and Schlumberger is French, but still, of those companies, when you look at their CapEx, for their, and they're mostly IP and other stuff, but those companies dropped their CapEx from a peak of 16.5 billion in 2012 to a cyclical low in 2020 of 3.6 billion. And now they're spending, the projections are for about 5.2 billion. So the providers of services, and again, this is like mostly IP, right? These guys they don't own rigs. They mostly don't own pressure pumping. This is supposed to be capital light. They underinvested in capital light stuff by $10+ billion a year. And they've been doing this. The upstream industry has been underinvesting for years by hundreds of billions of dollars. And the services companies have been underinvesting too for years now. So it's not just that you need 250 billion or 300 billion more of investment annually just to, be flat, but then you need to spend hundreds of billions more annually to make up for the years of underinvestment.
Didn't a lot of oil service companies and drilling companies that are hired by the exploration and production companies to drill the wells, complete the wells as part of the oil service business, didn't a lot of them go bankrupt in 2019 and 2020 during the short oil bear market that we had, where the oil futures temporarily went negative?
They did. Many went bankrupt then. Many went bankrupt in the big downturn in 2014, 2015, and then in kind of the echo crashes in 2016 and late 2018. So, I mean, it's been a oil bear market for almost 7 years, and then arguably a bull market now for about a year. So it was a rough time, especially on the services side. And what that means is not only was there not new investment, but there wasn't a lot of sort of basic maintenance capex either, which means that a lot of equipment that could have been around now from the last periods of sufficient capital expenditures has essentially either is no longer modern enough, and so it isn't usable, or it just wasn't maintained well enough and is now being scrapped.
And to add to your points there, during the short-term bear market, the oil bear market of 2020, when everything with the pandemic related was shut offline, we also had the oil service companies that were so desperate for business, they were discounting way below what they should have. So just to survive, just to get some cash flow, just to get people working, you had a lot of people leaving the industry. A lot of employees left that industry. I was speaking with Cuppy a couple of weeks ago. He told me that a lot of people went into construction instead because it's safer and there's a shortage of homes. So you had a lot of people that were in oil services helping complete wells with concrete and other necessities for construction there, leaving to go to regular home and residential home construction instead. So there was very interesting comments. I'm sure you saw this in the last couple of weeks from the Halliburton CEO. So they were talking about just shortages of personnel, shortages of steel pipe. And then on top of that, you have rapidly rising costs in oil services as well.
Yeah. I mean, labor is a big issue. There are various issues that have been popping up in the value chain as activity's been ramping back up. And, the current issue might not be the main issue a year from now. I guess labor is going to be a big issue, but like sand was a problem over the last, let's say, 6 months, and it's not really a problem anymore. And tubulars and other sort of consumables are a huge problem right now, and they may or may not be a problem 6 months from now. So it's kind of interesting through investing in upstream, mostly companies. We're doing some services now too, and a little bit of midstream. But through our focus on upstream, we end up seeing kind of where some of these constraints are opening up. And it's been really interesting seeing the evolution of these constraints as the industry attempts to go from almost fully stopped to running again.
So, but for listeners who are not familiar with the term tubular, you're talking about the steel pipes that are used to complete oil and natural gas drilling wells, right?
Yeah, and then also like liners and the various, there's a lot of different equipment that's used to drill wells, and a lot of that equipment ends up staying downhole. So you need to essentially, consumable is it's getting left downhole or it's used up as you're drilling or completing the well. And so you just need a new thing for the next well.
Now, were a lot of those steel pipes, were they being imported from Russia? Because Cuppy said a couple weeks ago when I interviewed him that a lot of that supply was actually being imported from Russia prior to the Russia and Ukraine in February.
Yeah, I mean, some of it was coming from Russia. Some of it is the inputs were coming from Russia and then it was fabricated elsewhere. Some of it was coming from Ukraine. And it turns out one of my friends, actually, he ordered the last shipment of steel from a steel mill where I think there are still Ukrainian soldiers that are under siege from Russia. That may have ended recently, I'm not sure, but as of a few days ago, there were still Ukrainian soldiers stuck in this steel mill that is mostly destroyed. And my friend actually was the buyer of some of the last steel that came out from there. So yeah, that's certainly not helping, but there was already an issue even before Russia invaded Ukraine.
So you think the oil service companies that you mentioned, the big three, do they have pricing power then where they're going to be able to keep raising prices and passing those on to exploration and production companies who want to drill new wells?
Yes, they do. I actually don't have any direct exposure to those particular companies, partly just because of valuation, but the market is valuing them like they have a lot of pricing power because they trade at mid to, I think, teens or even 20s multiples, which is pretty high relative to some of their smaller competitors. And so I think there's an expectation that they're going to pass through a lot of their cost increases and then generate extra margin relative to what they were generating previously.
So I want to ask you about cost increases then in some of the lower cost oil producing areas like the Permian Basin. How much are costs up in the last 18 to 24 months? Are we talking about the low cost producer like EOG Resources or some of the other low cost producers? The costs have gone from maybe $30, $35, $40 a barrel. Are we looking at like $60, $65, $70 a barrel production cost for these companies to generate free cash flow now?
Oh man, those numbers are always wrong. Like companies that were out there saying, we break even at $25 a barrel or 35. I think they were experiencing a lot of pressure in the downturn to make these representations. There was a really terrible bubble in the middle of this long oil downturn, and it just led to very bad behavior, and it was really inappropriate. So, when you think about the company's like cash flow break evens on drilling. The cash flow break evens are up. I think I'm more comfortable generally speaking to just the absolute numbers rather than to their break evens, because I think a lot of those numbers were just they weren't indicative of full costs. And so if you think about it, like if it was your business and like it was your money going in, and then you were hoping to actually get more than the money you put in out after all costs and including your financing costs. I mean, those numbers are just totally misrepresentative and not indicative of like what you would need if it was your personal company to invest and be able to actually earn a profit. I mean, the real break evens, including land and labor and financing and everything. I mean, these costs were even at lower prices than before service cost inflation. I mean, you probably needed $70 or $80 oil for most of these shale companies to earn a profit.
That was even in the supposedly low cost Permian then?
Yeah.
Wow.
I mean, it's not hard, right? Like you look at their financials and, I think David Einhorn's gotten a lot of flack for different stuff over time, but I think his Pioneer thing was pretty interesting. And I think even that, it was a little complicated because he was going after Pioneer for their full cost of stuff done at $100 oil when oil was down to 50. So I thought that wasn't totally fair, but it was still interesting because he went through and showed you, here's what they spent and here's what they got. And it was over a 10-year period. So that was fine, except most of that period oil was at 100 and then he was measuring it at 50. But now that we're back at 100, great. Let's like look at the last 10 years, 15 years, whatever. I mean, the full accounting, when you look at everything baked in for these companies, and I'm not picking on that company in particular, it just happens that he put out really extensive research on them a few years ago. It shows you if you can't find a profit in the GAAP accounting over time, right? Again, not on any given year, but over a multi-year period with a lot of money invested and a lot of money coming out of the business, then maybe your representations of earning a profit at a much lower oil price isn't those representations maybe aren't so accurate. So anyway, in terms of the actual cost, so, maybe a well was costing 5 million or 6 million at COVID lows and now might be costing 10 or 11 million now, depending on where you are in the Permian or where you are in the Haynesville or elsewhere. Some of the Haynesville wells now, it looks like are costing 13 million or more, especially for the extended laterals. And then those costs are continuing to rise in real time.
So we're going to have a new normal, you think, then, of a much higher price floor in the oil market, at least if the oil market acts rationally. If there's global macro factors and we have a crash, maybe oil prices temporarily crash, but then they would need to reset at a higher level in the not too distant future, because it seems like the entire industry, the new normal, is much higher production costs over the last couple of years.
Yeah, Jason, I really like that you put in that caveat, right? Like there's a lot of stuff happening right now that is very scary from a short-term perspective. There is a real risk that the global economy has some sort of significant negative GDP prints and recession. And so in that circumstance, oil prices could fall, oil and gas company shares could fall. But otherwise, I mean, we are in an undersupplied situation, and even with all of the issues, and even as we watch various tech companies blow up and their shares fall 90% and whatever, even in the midst of that, we're still seeing $110 oil, which is wild. And that tells you just how severe the undersupply situation is. And it's not what people are saying. It's not Russia, which we may get to later. It's not whatever. It's that there's just not enough oil coming out from projects that people expected more to come out from. And then there's more structural demand as the world reopens and gets back to normal. And so, yeah, I think there's a reset higher. And I think the mid-cycle price, people were figuring it was 50 to 70. And it seems like oil and gas equities are still kind of pricing that in. And I think that's wrong. And it's transparently wrong if you look at the company's financials and their financial histories. And then it's just a question of, will the whole industry get into this sort of circular firing squad again, where everyone chooses to lose money perpetually and go bankrupt? And I think investor willingness and capital availability is not there, at least for now, for the industry to do that.
So I do want to ask you about Russia. There's some other oil and energy analysts. I've heard a few people predict this in the last month or so, that over the next 6 to 12 months, because of all the problems in Russia's economy, that up to 4 million barrels per day of oil production could come offline. What type of supply problems would that cause for the global economy? What type of oil price then in that scenario would be looked at? And do you think that that's realistic then, or do you think that there's not problems then in the Russian oil sector for that much oil production to come offline, that's just a bad prediction from an oil and energy analyst trying to get some headlines?
Oh man, so many grenades that I'm going to try to avoid here. So I won't address other people's predictions. I've seen what you're talking about, as well as a variety of ones, ranging from there being no impact and 100% of oil being exported and just it being smuggled and whatever, all the way through to, like you're saying, 4 million barrels a day coming off by next year. And I think I'll kind of take the middle ground there. So it looks like there's about 1 million or so barrels a day of oil and refined products not being exported from Russia that wasn't exported from Russia in April. And it seems like there's like not perfect data, but there's enough different sources that indicate that there's plus or minus, there's about 1 million barrels a day that was missing. It might have been 1.5 million. It might have been a little under 1 million, but it's that band is narrowing for April. And so here we are in May, and the question is there more? And the answer is probably. There's probably closer to 1.5 million barrels that's not being exported between oil and refined products. I'm seeing some evidence that there was some oil that was being exported from Russia in refined product form that wasn't being reported as a part of their OPEC stuff. So actually they might still be exporting what people were thinking who are on the low end, but they're still missing, let's say, 1.5 million barrels a day, because there was some that they were kind of sneaking out around. So every other OPEC country or OPEC plus country was, conforming, and they might have actually been cheating on the quota. I just got some information in the last day or so from a couple of different sources indicating that. So fascinating. Doesn't mess up the OPEC plus spare capacity thesis, because this basically just Russia was being rational and responding to higher prices by doing this. But what it means is that you're probably not going to see 4 million barrels a day offline next year from Russia if things continue as they're going. In addition to just what's not getting smuggled out or exported currently through kind of hard to navigate sanctions. In addition to that, there's also the problem of oil fields declining as the oil services companies reduce their technology and reduce their labor provision to Russia. And the best estimates that I've seen are in the 1 to 2 million barrels a day of reduced production capacity, which is very different from export capacity, right? There's how much you can get out of the country, and there's how much you're actually producing. And so it looks like it'll take about a year for that to really kick in, and that it's reasonable to expect 1 to 2 million barrels a day less production capacity, again, ignoring the exact amount that's exported or not. So what that means is that if you look at every estimate of how much oil is going to get produced in the world and how much is going to get consumed, you really need significant demand destruction, whether through a severe economic global recession or through much higher prices, or maybe kind of Cuppy's thesis, the much higher prices and economic recession concurrently, in order to balance the market. And there's certainly not enough drilling activity, and there's not even really service capacity right now for the world if we all coordinated to try to get that production up, at least at current levels. I think it's gonna be really hard to fill that gap, and that makes me very bullish on oil, let's say 12 to 18 months as this production falls off in Russia. But again, from exports, it kind of looks like it's 1 million-ish barrels a day that's not leaving Russia right now that would have otherwise.
The average person also doesn't understand how rapidly the production declines for these shale oil wells. So after 2 or 3 years, the production rates for the wells may have collapsed by more than 75%. I think some of the wells even collapsed by 90% in only a 3 or 4 year span.
Yeah, well, Russia's not really producing much shale, but Russia production, and I understand this isn't Russia related, but just to clarify where those declines are going to come from. So Russian fields, some of them are low decline and some of them decline by 30 or 40% a year and require a lot of technology and a lot of careful attention to maintain production or increase production. And so that's where some of those declines that the various engineers and service people that I've met who worked on those fields, that's kind of where those estimates come from. For shale, yeah, I mean, a typical shale well will decline 70% or so in the first year and 80 to 90% over the first 2 years. So these are very high decline fields. I actually generally don't invest much in shale just because it's so service intensive and so capital intensive that there aren't many companies that earn substantial full cycle profits through focusing on shale development. And you really need extraordinary wells or really high prices relative to service costs to be able to make a lot of money in shale. So it's not been my main area of focus. And I guess that served me well, as many of these companies have been re-rated by the market. And as investors have kind of figured out what is maybe more sustainable from a production perspective. And then that matters because that's reduced the available capital. New outside money was kind of needed to come onto the shale treadmill to drill wells that would decline by 70% in the first year in order to show growth, right? If you drill 10 wells in a year and you start out with 1,000 barrels a day from each of those wells, that's great. You have, 10,000 barrels a day in your first month, and you have 3,000 barrels a day at the end of the first year. If you've promised people 10,000 barrels a day, now you need to go drill a bunch more wells to get back to that 10,000 barrel a day number. And it just the level of activity and reinvestment necessary really limits the production growth. And it's very service intensive, which is why it matters so much that there's been such underinvestment in the oil services part of the oil value chain over the last decade.
But a lot of the growth for oil production growth, especially from the US, was from shale oil. Now that it was a bubble, it was done inefficiently, it was done unprofitably, like you said. But a lot of these shale companies, they were run like Silicon Valley unicorns. They were just burning cash. The growth wasn't done efficiently. They weren't focused on free cash flow. They wasted a lot of capital. They were lying about their costs. I was looking at investors' presentations for some of these shale oil companies during the shale bubble, and they would only, and obviously this wasn't the full list of costs, but they were promoting in their investors' presentations on their website just the lifting costs. So you had to do all this extra work to try to figure out costs. The average investor who might have went and looked at the marketing materials, the investor's presentation, only saw the lifting costs mentioned a couple times throughout, thinking that, oh, they can make a profit at $30, $40 a barrel, where the management team left out all these costs that should have been itemized and mentioned.
Yeah, I mean, I was basically saying that earlier. It was really a problem, and it's not an accident that most of my investments right now are low decline producers with mostly conventional or at least not shale fields. And I do have some exposure there, but that's very targeted. It is possible to make a lot of money in shale. It just requires the right circumstance. And then in some cases, just getting a lot of value, a lot of historic investment in a field and being able to come in at a large discount to the historic investment.
So where do you think the oil supply, So where do you think the oil supply increases are going to come from? Is it going to be from deep water like Cuppy thinks, or do you think it's going to come from other countries and other areas?
I mean, it kind of needs to come from everywhere that it can. So I think there will be shale production increases. I just think there'll be a lot less than consensus. And so in our macro presentation, we show the number of times the EIA and then the IEA is the same problem. They keep resetting their production estimates lower and their forecasts for OECD commercial inventories. So the amount of oil that'll be in storage at the end of the year. Looking at their estimate for end of year 2022, it's been reset down 1 million barrels a day over the last year in terms of just how much oil they think is going to be in storage at the end of this year. And so just you see reset after reset down and down and down. And so I think there will be some growth in shale, and I think there'll be some growth offshore, but that does take a few years. And then I think you'll see, like you were saying, you'll see other countries that have onshore capacity. You'll see some investment and some tick up in production over time. It's just there's a limited number of people that still have the expertise who are still in the industry that can go to onshore Angola or onshore Argentina. And often there are a lot of very restrictive regulations and taxes, and then there's all kinds of corruption and other issues. And so, it's possible, and at a sufficiently high oil price, you'll see more and more of that activity. But it's taking a lot of time to kick in. And I think it's hard for a government agency or a big consulting firm that's very bureaucratic. I think it's hard for them to understand. They experience their own red tape and their internal stuff, but then they look out and see an efficient world. And I think it's an advantage of being an entrepreneur, having run oil companies and done consulting to big companies and so on, but just understanding kind of how complex the world is and how hard it is to ramp up stuff from basically a standing start. It could take many years to get the amount of oil produced that would actually push oil prices down materially.
There were some very interesting comments this week from a Saudi oil minister. He was talking about Capex problems across the board, not just in oil, but natural gas, uranium, all coal, all the energy industries, all the things that are needed for baseload electricity generation and transportation. There's a dramatic underinvestment, he said, on the supply side for all of these forms of energy.
Yeah, I mean, I think I agree, and it's similar to what Hess's CEO said, and similar to what we've been saying at Bison for a while. I think one thing. So we put out a white paper on this in January on drilled uncompleted wells, and I think you've referenced this a couple of times so far in this conversation that there's just been insufficient drilling to be able to restock the working capital for these companies to then be able to complete wells and tie them in. And you referenced it in their accounting too, right? There's all these different activities that weren't talked a lot about because it's almost like the companies could, by not talking about them, not remind investors that there were these costs that they were going to have to pay to get the oil out. And then, so you really need a lot of investment. And then, again, there's just not service capacity, right? A lot of the equipment doesn't exist that's necessary to do the things that people are saying should be done or need to have been done already. And so, like, for some of these things, you need to start building new rigs and new pressure pumping, and you need to expand factories that can build tubulars. And it's just not, people haven't started doing that yet. And so those things all take years to get retrofitted and then to start building them and then to roll out enough of them and then staff them and then have that staff be efficient enough to operate them in a manner that's comparable to rigs or whatever that are being operated now. So, it's really a bottleneck that is, I think, it's hard to overstate the problem.
And it could take 2 or 3 years to restart some of these steel manufacturers to make the steel pipe here in the US, because these are basically cold stacked, to use the term for the deep water rigs. These are not factories that are running now. These are factories that are totally offline. So they'd have to hire new personnel. They'd have to get permits and approvals. There's probably capital problems. So it would take a lot of different things: rules, regulations, red tape, taxes, capital, hiring personnel, to bring these factories back online to start making steel pipe here in the US or Canada.
Yeah, I mean, that's an issue. And those would be the issues if this was just a normal cyclical sort of upcycle for oil. And that would be kind of, if you think about the upcycle from 2001 to 2014, and really the reset from 2001, where oil was 10, to 2008, where oil got to 150 or 147. There was all of this stuff that we just talked about that was necessary to rebuild capacity, and it took years, and everyone hated it, and everyone kept predicting that oil would fall because of all this activity. And it did eventually fall in 2014, but it took years to build the capacity and then more years to actually engage in the activity with that capacity in order to eventually end up with so much oil that the market was flooded. So that was already a long cycle, and it took many years to get enough production and to innovate various technologies and techniques to be able to produce more oil. But now we also have these COVID bottlenecks. So we know we need more oil. We know we need to, add to fabricators or do other things, but we can't even do that because everything is stuck and China's shut down again, right? So like, where are your various spare parts going to come from for your existing stuff? Forget building a new factory and or retrofitting an existing one, or bringing one out of mothballs in order to build it. And a lot of these factories have been torn down and scrapped. There's really not a lot of capacity to build more of these things. There's really going to be a lot more sort of greenfield projects necessary rather than brownfield, and that means it's going to take a lot more time. And it plays into this sort of supply chain issue that the world is dealing with post-COVID. So I think it just adds another couple of years to the lead time before you can really get enough of a ramp up to really flood the market with oil.
And then on top of that, you have a much higher cost structure for a lot of these formerly low-cost producers. Their costs might be up 20, 30, 40% in the last 2 years. Do you have an idea then of how much the Saudis have had their cost increases? Because they were the low-cost producer. Are their costs up 30, 40% in the last couple of years?
I don't really trust their financials, and I think it's really hard to tell. I think my proxy for Saudi's cost has been their use of offshore high-spec jackups and other equipment and other professionals who come in as expats and, cost Aramco $1 million a year a person to be out there. And, it just doesn't, you can see what the productivity is per well, and you can see how much it costs to drill them and how many wells they actually drill. And you get to a number that's very different from their financial statements, but I haven't audited them. I don't have any, it just hasn't made sense to try to do that. You can kind of see how much money is getting distributed by Aramco to to the government of Saudi Arabia. And I think that's kind of indicative to some extent of how much money they might be making. They are underinvesting in their fields, like you were saying. And so it's not perfect, but kind of directionally looking at the distributions tells you kind of what it costs them. And it's probably, $50 a barrel rather than the 10 or something that they say. So it's not bad. I mean, they're making a lot of money right now. I think Aramco is now the biggest company in the world by market cap. But it's also, it's 50, not 10. And that's a very big difference in terms of profitability. And then it also tells you if it's 50 and, Saudi Arabia runs their whole country on the distributions from Aramco, basically, then they need 80 or 90 or higher dollar oil just to balance their budget. So, and that's true for other OPEC countries. So this idea that there's ultra low cost oil available in OPEC, even to the extent that there still are fields that are highly productive there, it's not indicative because the social costs and the government costs really have to get factored into the break-evens.
And I've heard anecdotal stories from oil service workers that are Americans working in Saudi Arabia for years talking about how much they've had to water inject their wells. So that adds a lot of extra costs that were not being mentioned publicly in their financial statements. And the Saudis were continuously saying that their costs were $10 or $20 a barrel. And then I was hearing these anecdotal stories about how much water injection they had to do the wells and all these extra costs. So what they were saying, what you said about their financial statements versus the reality of what I was hearing with the stories, it didn't match.
Yeah, the feedback, it was very interesting publishing this work. So we initially talked about the OPEC Plus problem. I think I did it on a podcast actually with Cuppy. He hosted something and it was around a year ago. And then we published our white paper, our first one in September of last year. And it was so interesting to see what happened. So there's various people who are employed as essentially investor relations for Aramco or consultants for them or whatever. Like there aren't that many oil experts that are around just kind of hanging out because the industry was in such a bad place for so many years. Many of the independent analysts either went out of business or they went and essentially got sponsored. They got jobs from various countries, various companies, et cetera. And so you saw people slam this analysis in many cases without even evaluating it. And then, so publicly, we were just getting scorched. And then what I wanted was what I got, which was a lot of individual people reaching out via Bison's website, via Twitter, whatever, being like, hey, dude, like I was on those fields. It's a bigger problem than you're saying. And so it was this very weird thing where like public experts who have tens or hundreds of thousands of followers on social media who get paid all this money and are on TV all the time. And like these people were like, this is wrong. And then the people that actually know what's happening, who worked on the fields, who engineered the fields, were reaching out, many people, not one or two, many, and telling me that I actually understated the problem and that, the work that we did at Bison was actually, they thought we materially overestimated the production capacity of some of these fields in some of these countries. So consistent with what you're saying, similar experience. And, when one or two people tell you that, it's like, okay, whatever. When you have dozens of people that were, some of whom were pretty senior at very big oil services companies, at very big oil majors, I don't know. I just don't see their incentive to reach out and say, hey, yeah, to share something like what they shared about their specific experiences in engineering and working on these fields. And it's not just the water. There's all kinds of chemicals and surfactants. There's all kinds of equipment. And again, like the really easy thing for me is just to point to high spec offshore drilling rigs being used by Aramco. Like it doesn't make sense. You can't reconcile high spec offshore drilling with $5 or $10 a barrel production costs. Like it just, those two don't reconcile.
Yeah, I totally agree. And Matthew Simmons actually wrote a book about this because before a lot of foreigners were allowed to visit those oil wells like War and others, Matthew Simmons was allowed to because he was an oil investment banker. And then he wrote many years ago before he passed away, Twilight in the Desert. So he was warning about this, that this would happen. He wasn't right on all of his predictions. Obviously, he didn't think that the shale bubble would be subsidized to the levels it was. He was talking about how uneconomic it was, but look at the trillions in wasted capital that was used to produce oil and natural gas inefficiently. So let's transition now to natural gas. Do you think the new normal for natural gas prices here in the US is much higher than the bear market that we went through with all of that uneconomic shale supply, the shale gas byproduct, a lot of it that was flared off?
Well, before we move to that, just on Matt Simmons. So I think he was right given the technology at the time. So I've met some of the people that actually fixed some of the problems that he identified. I think he was early. And often when you're early, you're ridiculed. And your memory is kind of, unfortunately, like, people are very negative about your work. And I think he identified problems that were accurate at the time. And having met people that have solved those problems, it's like, okay, well, that wasn't a problem anymore, or isn't a problem anymore, but now this next thing is a problem. And so, again, like, it's possible to correctly identify something, for it to get fixed, and then for there to be a next problem that ends up with a result that's even more extreme than what he forecast. But it just, the can got kicked down the road for some amount. So in terms of natural gas, yeah, I think this idea that we're going back to $2 or $3 natural gas and it's going to stay there for a while is ridiculous. And I mean, it's not even shown in the forward curve anymore, which isn't a great predictor, but you see $4 to $5 natural gas in the forward curve as you look out for the US, and similar for Canada. Similar issues with shale oil. Shale gas is more productive, so there is more of it. Maybe shale oil could get to another 2, maybe 3 million barrels a day total production capacity over the next 5 years if we really ramp up. Shale gas, I mean, we could go a lot bigger if there were more pipelines and if there was more development. But one interesting thing, I think, over the next, this is more of a medium-term issue, as oil prices went up and then gas prices went up, there's now this conflict right now, and people don't really talk about it because it's not so transparent. But if you have a rig that's available for someone to use, is it going to go to the Haynesville to drill a gas well, or is it going to go to the Permian to drill an oil well? Or actually, while we were talking, a friend texted me, apparently Apache has started drilling gas wells in the Permian again, in an area that's highly unproductive, that they had to write down years ago and took a multi-billion-dollar loss after the sort of activity we talked about, where they made claims about productivity and that weren't so good. So there's this really interesting dynamic right now where service costs are getting pulled higher, partly because oil's high and partly because gas is high, and especially because oil and gas are both high simultaneously. And so I think you end up with service costs to the point where you end up competing out some of the higher cost gas fields and some of the higher cost oil fields. And I think that's part of why I don't think you end up with as much production growth as the consensus is expecting, because you end up with it being kind of less efficient and you just have fewer rigs. $100 plus oil, oh, you're going to have 1,000 rigs eventually, maybe, but it's going to take you twice as long if gas is at $7 or $8 and you have an extra 200 rigs eventually ending up on shale gas. So I think it's probably the biggest issue, is that both prices are high simultaneously, and at the same time, the industry is undercapitalized. And so there's really there's not that investment to build more, at least not a substantial investment. And there's not enough capital to really get all these projects done all at once.
Tracy Shoechart, who is Shy Girl on Twitter, she pointed out in the last couple of months that there's actually, I think we're at a 5-year record low for U.S. natural gas storage levels. So we're way below where we should be. Now, some of that is LNG, liquefied natural gas exports, but also because of how much supply, how much natural gas production has come offline in the U.S. Do you think that we're headed towards a long-term natural gas bull market, though? Because it seems to me that electricity generation, demand for electricity, it actually surprisingly in 2021, despite the pandemic and so many businesses shut down, lockdowns, there was actually record electricity demand growth, I think globally 6%. So do you think then that natural gas is going to be the main beneficiary of this global electricity demand growth?
So Tracy and I were both gas bulls last fall, and and I have to really commend her. She was very early in identifying, I think she actually like quoted Bison's white paper on OPEC plus spare capacity last fall. And she was essentially an early adopter of that. So I think that was very impressive. I think she's one of the very few kind of public oil personas who was able to, she actually read it and was right in kind of identifying it as a real issue. She was right with me on gas last fall. She connected the dots and identified fertilizer and some other stuff as issues, as kind of knock-on effects. I think it's complicated. I think it depends on how much gas production grows, how much gas gets exported via LNG, and how quickly export terminals come online or expand their capacity. I just don't think it's very likely that we get back to price levels that we saw in 2020 or 2021. Like I think we're probably done with sustainable $2 to $3 natural gas. And then I think it's just a question of, is gas $4 or $5 next year, or is gas $10 or $15 next year? And I think there's enough different variables that are hard to predict that I'd rather just give that range and say I don't know, because I don't know that anyone really knows. And I think if you ask Tracy, my guess is she would also point to a range like that and acknowledge kind of the higher price than actually the last number of years, but the possibility of a very wide dispersion of potential outcomes.
Well, I think that range that you just quoted, a lot of it depends on if China decides if they want to switch a lot of their coal-fired power plants away, like what the US did during the shale bubble, switch it to natural gas. So if China switches a lot of those coal-fired power plants, like say 20% or 30% of those over to natural gas, that's going to cause a much higher price floor, a big boom in natural gas prices.
I actually don't know. I don't know that I agree with that. I think it's an interesting theory. I think China has some issues with using coal in terms of the leadership's popularity. Like the more coal they use, the more pollution there is, the less popular their government is. And they really are governing at the whim of their people. I know it doesn't seem like that, and their shutdowns right now are very bizarre, but they're also very unsustainable. And generally, they've tried to act to improve the lives of as many of their people as possible, while also essentially, significantly personally profiting off of it. So I don't know. I think when I was thinking about that, I was thinking more, how much does US production grow? So how much are the producers able to actually address these various supply chain bottlenecks? How much does gas prioritize Capex versus oil within the industry? Like how much incremental activity is focused on gas versus oil? And then, is there a hot summer? Is there a cold winter, or vice versa? So I think there's some weather component, and there's some industry activity component and budgeting component. And I think those are the things. And then there's these logistical hurdles. And so I think those are the things that I'm focused on. And I think there's just enough uncertainty, especially around weather, but some of these other factors as well, that I think it's just appropriate to have. And maybe China is an issue too. And I don't know that I fully understand that. But I think it's just appropriate to have a wide range and understand that wide range is very different from what we saw for most of the last decade for natural gas, and is a much higher average price than what we lived through for the past decade.
And these much higher natural gas prices in the US, European Union, United Kingdom, they've caused they're a main component then of higher food prices and the fertilizer shortages, or much higher fertilizer prices if a farmer can actually get the fertilizer.
Yeah, I mean, I think the European natural gas price should be differentiated from the US one. There are some connections. So like fertilizer plants and certain other activities in the US are running higher utilization now than they would be, because plants were turned off in the UK and in Europe because of high prices. So there is some incremental demand here, but mostly the high prices in Europe are driven by poor energy policy and kind of bad regulations that discourage production, that turned off nuclear power plants, and that really made those places dependent on Russian exports, which have slowed down. So that's kind of its own whole world. that being said, high natural gas prices across these different jurisdictions are leading to shortages of fertilizer, much higher fertilizer prices, and various other implications that are very inflationary. And I don't know. I mean, I think it's very scary to see the Federal Reserve trying to, I mean, we just are living through interest rate rises that are attempting to lower inflation when the inflation is driven by scarcity of commodities. Because, right, it feels like the Fed is trying to kill demand for basic goods that are necessary to live. And so the implications are a little scary. And, I've just been thinking through this. I posted a little bit on Twitter just to get some feedback from people. And some of it was very negative and kind of aggressive, but very, very interesting and kind of scary to have fertilizer shortages because of what it means in the modern world.
Yeah, you're seeing just riots because people are literally starving. They can't afford, there's either shortages, bans of food where it can't be exported, or people in poor countries, developing countries, they can't afford the increase in the food costs and their governments aren't subsidizing it. And so now there's riots in Sri Lanka and many other countries because of higher food prices, similar to the Arab Spring in, 2011?
Yeah. So actually, one thing that I've been doing about that, and, some people like donate money to feed people in Ukraine who are starving or whatever. There are various sort of ways to virtue signal. One thing I've been doing as an investment fund manager, identifying an energy crisis and an energy shortage, is I've actually been funding additional development of additional oil and gas wells in the U.S. and Canada through offerings, through finding companies. I may end up funding wells directly as well. And I can't make a huge difference, but someone donating money to some charity wherever is also probably personally not making a huge difference. But I think in aggregate, a little bit more development, especially on the conventional side, where the production's not going to fall off a cliff right after it comes on, where it's high energy return on investment. So the energy used to get the oil or gas out of the ground is a small percentage of the energy that'll be produced from the commodity once it's extracted. I think it's and this might sound weird because they're, part of the bull thesis on oil and gas is capital constraint. But I think there's kind of this moment where you see potential starvation and other like real significant human issues. And you say, okay, like maybe it's not so bad if oil's at 100 instead of 110. And frankly, like I'll make a lot of money on investing in these growth projects. And it's not all of what I'm doing, but it is, I have been doing more of that because I think it's both profitable as well as the right thing to do. As you see, I mean, there were riots in Sri Lanka this week. There have been real issues in a number of very poor countries where, very poor, disenfranchised people are having food shortages. And so I think in the face of that, it makes sense to invest a little more in energy production capacity.
And food and energy are very related. So to produce food, to produce calories, you need a lot of energy. So the average person doesn't understand that. So if there's high energy prices, whether that's transportation costs, right now we're seeing these huge price increases here in the United States. I just saw a story out a couple of days ago about a diesel shortage now here in the East Coast. So the diesel prices are unbelievably high. We could talk about this as we wrap up the interview, get your thoughts on the diesel price spike, the diesel shortages, how long this may last, and potential investment opportunities, if there are any. Maybe there's some type of pure play here for retail investors for the diesel price spike.
Yeah, so I think, refinery equity prices are already quite high. There's probably going to be good crack spreads for a little while because this diesel shortage that you're seeing, I think, is just the start. The next thing that you're going to see in a month or two, it's going to be all over the headlines, is a gasoline shortage. And I was just on the phone earlier today with a retired trader who did a lot of physical trading of these different refined products. And, he highlighted this for me, and it was something I'd already kind of identified and was working on. So this is a seasonal period of shortage for diesel. And so seasonally, refiners are producing more diesel right now because of seasonality for farming and other sort of time-specific, calendar-specific needs for diesel. Gasoline's coming up next, and there's not enough gasoline getting produced. And even as these refineries turn over and shift towards gasoline-oriented refining, there's not going to be enough. And so prices are going to be a lot higher at the pump. That being said, I'm not sure that investing in, at least for me, the way I think about it, I can't give other people kind of specific advice through this sort of format, but I'm not compelled to go buy refiner shares at multi-year highs when the crack spread is at multi-year highs. It makes me think of the last couple of times in my career where this happened, where it looked like it would last for some amount of time, and it did, and then the shares collapsed. And so, I think you want to own something. When I think about what I want to own, I think about things that have some potential duration and some extreme discount from a value perspective. So I think there might be too much consensus that this refining issue is going to last for a while, and I think that might be priced into shares. Whereas I think the real winners from this aren't, maybe the refinery stocks go up more, I'm not sure, but I think the real winners are going to be the value priced oil and gas producers, because when you look at the last times gasoline prices really spiked, people go to a gas station, they get shocked by how expensive their gas is. Not like when it went from 3 to 5 or whatever, a month or two ago around the Russia invasion of Ukraine, but a real spike. So on an inflation adjusted basis, the equivalent of what happened in 2008. When that happened in 2008, people turned around and bought aggressively small cap oil and gas stocks. That was where you wanted to be, because it was just this almost like intuitive thing. Okay, there is an oil shortage and I will go invest in oil producers, and I'm not going to go buy, Exxon went up a little. I'm not going to go buy Exxon, despite what my broker tells me, because obviously Exxon isn't going to benefit as much as a big producer at a high valuation. And this little company that I saw some ad for, or that my buddy's buying or whatever, I'm going to go buy that one because that one's going up. And, you saw a whole bunch of, in many cases, low quality producers, you saw their stocks go up 10x or whatever from the start of 2008 to the peak as gasoline prices spiked. So I think if people wanted to bet on that or wanted to somehow benefit from diesel prices spiking, I don't think diesel is the real story. I think gasoline is going to be the real story. I think it's going to be, and this is going to age poorly, because for the next month or so, diesel prices will be high. It'll be all over the news. People hear this and be like, what is this guy talking about? Similar to OPEC stuff, just wait. There's going to be a gasoline shortage, and there might be gas lines. I don't know. There's like weird bills in Congress right now. And I think the play is just these low decline, extremely low valuation producers where their stocks are up, but where they're still extremely cheap. You own them at 2 or 3 times cash flow. They're growing, paying off debt, like the most stable they've been in a long time, if maybe in their histories. And I think those stocks just go crazy. And so that's how I'm getting positioned for this.
And to add to your points there, historically, oil refining stocks are not good long-term investments for buy and hold over a couple of year time span. The bull market for U.S. oil refiners was during the shale bubble, while oil prices were collapsing because the U.S. was flooding the markets with too much supply, not done at a profit. And the refiners were benefiting from this with falling input costs.
Yeah. That was one. Another was, as gas prices were rising in 2008, you did see crack spreads blow out. And so there was a story about demand rising faster than refining capacity, which is actually similar to the story now. And similar to then, you have a lot of international capacity, and some of it was underutilized. Some of the current international capacity is underutilized. I saw a giant refiner that had been offline, I think in Singapore for the last 2 years, just turned back on. There is a lot of capacity still. And it's like, there are these very weird stories where people are like, oh, there's this refining shortage. And then LyondellBasell is turning off a big refinery on the Gulf Coast. And then, Shell just sold a refinery in Alabama. Retail investors are getting very excited about this company that bought a very simple Shell refinery in, I think, Alabama. And you look at it and you see the likely potential sort of turnover costs and end of life costs. And then you see that it's making money, but maybe it didn't make money over most of its history. And yeah, I don't know, maybe that stock goes up 10x. I'm not sure, but it doesn't seem like that sort of setup is promising from a long-term value perspective. And so it's not really where I focus. And realistically, I think people's inclination isn't to go to the gas station, overpay for gas, and then turn around and buy a refining stock. Similar to how Congress and the president have been upset about higher prices at the pump and getting mad at oil companies. There is a similar sort of psychology there where I think the valuations and the money flow seems most likely to go to oil and gas producers. And again, I think what we saw historically in multiple upcycles for oil and gas, when there is that sort of big move, particularly in gasoline prices, it looks like where the money goes is small cap, publicly traded oil and gas producers. And, I like those anyway because they're cheap and they seem to be good multi-year value investments. And so I think there's a pretty good shot that some of these stocks just go absolutely crazy this summer.
Well, Josh, you are a wealth of information. I want to thank you so much for your time. I've kept you for over an hour. I really enjoyed the discussion, and I think my listeners will get a lot out of this with all the different oil and supply and demand analysis.
Great. Thanks a lot, Jason. I appreciate it.